If you look at the people who produce the sand which is needed for fracking, they've been going down, down, down. So it indicates, you can look at the rig count on one side, but if you can look at some of these other indicators, these people are heavily in debt, having leveraged up. We talk about Chevron and Exxon or whatever, but you've got hundreds of little companies out there that have these
true.
small fracking operations.
And we've made the point, of course, the high yield market, it depends who you talk to in terms of the percentages, but 15, 18 perhaps % of high yield is actually related to energy. It's about a $1.6 trillion market high yield versus $5.5 trillion or so for investment grade, but worth keeping an eye on.
And surprise, surprise, the strategists are expecting oil prices to go higher in 2019. Boy, were they wrong in 2018. Just looking at the opening trades here and continuing, Art, this theme of just broad weakness. You really don't see any pockets of strength. All 30 Dow members are lower right now. All S&P groups are lower right now. If you had to look for outperformance over the last year, you saw it a little bit in healthcare and utilities. Does that tell us where we need to play deep, where investors should be playing defense this year?
Well, it tells you that you wanted to stay onshore. Healthcare clearly is an onshore game, and so you have to look out for where things are going. Now, everybody is terrified that this is a sign of a global slowdown. Remember, it was only 8 months ago we were talking about synchronized growth.
Yep.
And all that has fallen apart. So now the few bulls who are out there are saying that the reason that the Chinese manufacturing number dropped is partly because China is trying to de-emphasize exports and emphasize self-sustaining services and whatnot. But the markets tend to believe the skeptics here and are not buying it.
Well, you can see the ripple effects in South Korea and some of these other economies that are tied to China. Copper was down 20% last year. And I think that the conversation, Art, has gone from no longer synchronized global growth, synchronized global slowdown that appears to be getting worse as places in Europe actually start to join the fray. We're heading into a Brexit deadline in March with no clear deal on the table there and a number of weakening surveys across the region.
Well, you had one or two individuals come out and say that they were shorting broadly the British market because they think a hard Brexit could wind up with real damage out there and could be followed by another election and May's party could lose the general election, and that would be bad for business too, they assume. So it looks like we're not going to be able to catch up on our sleep for a while, as 2019 is going to be as volatile as 2018 ended.
And Art, before we let you go, any levels you're keeping an eye on this morning?
Well, you want to watch the 22.6 level, and that would be important. And for the S&P, I would say you've got to go down around that 2,400 point and see. So that's looking for a big sell-off here. It may not come, but if we get into one of those free falls like we saw a couple of times in the last 10 days, that's the area to watch. Yeah.